Hello, everybody. This is Mike Hengehold. Thanks for joining us today. I am joined today by Doug Johnson. Doug is, as you know, one of the partners here at HCM Wealth Advisors, and Doug chairs our investment committee. We have a lot to do today. Just a couple of the basic administrative announcements are, of course, that there will be a replay available if you're interested. It'll be available on the website, hopefully by tomorrow. If you have questions, if you hover down at the bottom of the screen, there should be a Q&A button, and you can send questions to us that way. And I think that's probably everything we needed to cover. So with no further ado, Doug has a little bit of a Bengals review for us, I think.
So yeah, some people may want to look away from the screen, but
if you can handle a little deja vu, but we're still reliving the Super Bowl here. So
yeah, so just so we're all
there. You tell me.
That's what they called.
Yes, it is.
Wow, in a game where there have not been that many ticky-tack fouls.
So I think Chris really wanted to say something else, but he was being very, very diplomatic about that.
Yeah. So, as I said, we're still reliving that experience. As I said, we have a lot to cover today. We have made some changes in our portfolios, and we want to walk through a lot of the reasoning behind that. Before we go there, though, there are two things I wanted to mention that are, one's newsworthy, one is significant on the sort of retirement/tax planning side of things. The first is, as most people know, the big tax bill that was on its way moving through Congress stalled in the Senate as it could not get enough votes to get through. Now, it is so that was good news from us because it made a lot of changes to estate planning and income tax rates that would have been detrimental to a lot of HCM and HG clients. These are things that we like to prepare for, and of course, they were cruising towards an end of year signing that would have created some problems. So it's good that that was either eliminated, postponed, extended, whatever the circumstances are going to be. The administration talks about the fact that the bill is still there, it's still alive, and what they intend to do is break it into pieces and try and pass it in pieces. The reality is we're doubtful about that simply because we have an election year and the inflation that is sort of being spewed out of a lot of the relief money and other COVID-related issues is sort of taking center stage. So it's going to be difficult to pass an additional tax bill this year, but we will be keeping an eye on that. If nothing else, we think it's highly unlikely they'll be doing anything that would be retroactive. So we would have the bulk of the year to get ready if they do in fact change the rules. So that was thing one. Thing two is a news item. You can go back one slide if you don't mind, Doug. Thing two is a news item for people who are considering retiring early. And by retiring early, I mean before 59 and a half. Most people are aware of the fact that if you take money out of your IRA before 59 and a half, you've got penalties to pay unless you take it out for one of a laundry list of reasons. And there are a number of reasons, most of which are hardships. But one that's not a hardship for people who are planning for retirement is a situation. If you agree to take a series of equal period payments over a specified period of time that's not shorter than either 5 years or until you would get to be 59 and a half. So in other words, if somebody retired at 50 and entered into one of these deals with the service, they would have to take these payments for 10 years because they'd have to get from 50 to 59 and a half. In any event, this has been a problem for people who wanted to retire early because the calculations that you go through in order to determine the amount of money that you're allowed to take requires I'm going to use air quotes now, a reasonable interest rate. And the service declared that a reasonable interest rate was 120% of the applicable federal rate. And I don't want to get too far inside baseball, but every month the service, every month the service publishes a list of interest rates. There is a midterm rate that's used for these calculations. And the problem is when you do the calculation, because interest rates are so low, it forces you to have a relatively small distribution that you can take penalty free. And for people that are otherwise properly capitalized, but from a tax planning perspective, want to take a certain amount out of their IRA to fund tax brackets, this is a real obstacle. So the service has actually come to the rescue here. Now we can flip to the next slide if you don't mind, Doug. And they've released this IRS notice, this 2022-6, and within it, what it does is it goes ahead and repeats that a reasonable interest rate is still 120% of the federal midterm rate, or 5%. And 5% is substantially higher than these rates, and therefore allows us to, in doing these calculations, generate a much higher payment. From a planning perspective, that's handy because people typically, again, because of that 10-year or that 5-year or until you're 59 and a half time requirement, what we like to do is make the election to the smallest IRA possible. So we will fund an IRA strictly for purposes of this election, but if we want to make it as small as possible, so we're not tainting more retirement money with this election, we want to get as much juice out of that lemon as we can. And this now allows us to do that. So by way of example, Doug, if you don't mind going just to the next slide very quickly. This just gives you a comparison. There are three methods under these substantially equal periodic payments that you can use to calculate distributions that will pass these tests. The first is an RMD method. That's similar to what people have to do when they're 70 and a half or 72 now and so forth. You use a table, you determine an amount. The other two methods, the amortization method and the annuitization method, are the ones we're talking about that use this interest rate. And you can see that under current rules, just using the amortization method, for example, we would go from about $36,000 to more than $60,000 by simply changing the interest rate assumption. So this gives us a great deal of flexibility for people who would like to retire before 59 and a half, or semi-retire to supplement part-time work, whatever they would like to do. And that really summarizes the important news that's come out recently around retirement and taxes. And now, Doug, if you want to take a bit of the show and let's talk about some of the decisions we're making in our portfolios and the reasons why.
Sure. Yeah. So obviously a lot of ground to cover today. It seems that equity volatility decided to really kick up. I want to say the day or two after we originally did the webinar in January. So certainly a lot to go over there. I want to take some time to talk about that volatility and put it into some relative terms here. And then really take a look at the situation that the Fed's in with inflation, and then go more in depth into some of the previous rate hike cycles that we've seen, and do we think any of those might mirror the one that we're about to go through, and if so, how does that relate to any portfolio adjustments? So just to start here, this is year-to-date returns for several equity categories. You have the green and blue up here as the best performing asset class. Green is actually international, so I know that'll be a shock to some people, but international assets have actually held their own this year, which is a nice surprise. The blue is the iShares Russell 1000 Value ETF. And then as we work our way down, the purple represents the S&P 500. The kind of, maroon or pink color represents the Russell 2000, which is small cap. And then the orange represents the Russell 1000 growth. And then you'll also see these dotted lines here, which represent the low point for the year. So, we've got a little bit of volatility going on today. So those prices will not be reflected in these numbers. And we still haven't reached those lows. But when we talk about volatility and how that looks this year, we've had a fair amount of it. You've had almost a 10% drawdown in the S&P 500. You've had almost a 15% drawdown in the growth category. And then you've only seen about a 5% drawdown in value. And this is a concept I think that we've talked a lot about in previous webinars and in previous communications through our market insights about how we believe that there's going to continue to be a little bit of divergence here between value and growth going forward, where in the past growth has been kind of the dominant sector and has led markets forward. So if we look at that relationship on a little bit more granular level, we can see that the relationship on the large cap basis from growth to value, again, going back to 2018, these are just ratio charts. When this line is moving up, it means growth is outperforming value and vice versa. So we can see ever since 2018, we've had a really good relative performance for growth, accelerating into 2020 as kind of COVID lockdowns happened. You had a lot of stimulus coming through. Then right around election time, let me pull up my laser pointer here. Give me just a second. There we go. So we reached this inflection point here in the relationship. And then you have value leading growth right after the election, right after the administration or rollout of the original vaccine. And again, this was before we had Delta, Omicron, any of those variants. And then we got to about the middle of last year and we saw a little bit of growth resurgence. And now we're back in the yo-yo, so to speak, of value being the leader. But one interesting thing to note is this kind of pattern that's forming where you're getting this almost dog ears or Batman ears, where you've got one hump here, another hump here. And then we believe, and we'll show more evidence of this throughout the presentation, that this value outperformance has a long way to go to not only get back to the original relationship before we had COVID, but maybe even further than that going forward. And we can see in the small cap area, that normalization has already happened a little bit, where you've had this big peak in growth, then you've had a resurgence in value, and you're almost back to those levels. But we certainly believe that that value can continue to perform well, and it will perform well going forward. Now, as we look at volatility and try to conceptualize it, compared to some other drawdowns that we've seen over the past 5 years, this chart denotes the Vix Index, which is just a measure of volatility in the marketplace. And the higher the Vix level, the more volatility that we're seeing. And then the orange line here just simply represents the return cumulatively for the S&P 500 going back to 2017. So we can see when this Vix level spikes up, it's not abnormal then for equities to have a significant drawdown. And as we compare the level of volatility that we've seen recently, it compares very well to the end of 2018 and the beginning of 2018. And the situation that you had at the end of 2018 was very much related to rates. We were kind of at the end of a rate hike cycle, and the market just kind of buckled under all that pressure and said, we can't handle any more rate hikes. And the Fed duly kind of backed off, dropped rates down, started QE again, and then off we go. Obviously, we had a major VIX spike here with COVID, but in terms of, is this volatility more or less than we've seen in the past? I think it's probably right in normal line with a 10 to 15% sell-off in the market. It's certainly not one that you'd associate with a 35%. But I think, trying to look at this and say, is this normal? I think it's completely normal to see volatility spikes like this. And we'll talk a little bit about why we think that volatility is going forward. So I had some questions coming in here. So one of the questions is a little bit further explanation of the growth value ratios. So let me just take a step back here. So when we're talking about the growth value ratios, we're really just looking at the relative performance between large cap growth versus large cap value. So again, as this line is moving up, large cap growth is outperforming value. So that could mean a number of things. It could mean growth is up 30 and value is up 20, or it could mean that growth is 0 and value is down 10. It doesn't necessarily have to be a positive performance differential. It could be a negative performance differential as well. So usually what we see in the growth value relationship is that growth tends to perform well in low rate, low inflation environments, which is what we've had for quite a while now. But as we're moving into more of a value, or more of a higher rate environment, more of a higher inflation environment, value tends to lead in that regard. And we're going to get into some more detail on that as we go through. So I hope that answered the question. If not, please feel free to follow up with us, and I can give you certainly a more detailed description of that.
Hey, Doug.
Yeah.
I think to kind of round out that question, it might be helpful to maybe add why that happens with, growth stocks sometimes have earnings that aren't even happening yet. They're going to be sometime in the future. And the higher the interest rate, the more we're sort of discounting the questionable results out in the future, as opposed to value stocks, which tend to have results in the here and now, maybe.
Yeah. So when we talk about that concept, it's really the idea of duration. And we talk a lot about duration in bonds. And duration is just kind of a fancy way to describe the relationships between price movements and interest rates. So a lot of kind of growth stocks project to maybe not make money now, but maybe to make money 10 years in the future. So they're on a much longer time frame in terms of what their earnings picture looks like. And that gets discounted based on interest rates. And when interest rates are basically nothing, all of those earnings can be pulled forward. But when rates move up, we get that discounting mechanism in there, and then the pricing adjusts to basically normalize the fact that you could take that money and put it into a money market or a bond or something like that and actually get some kind of income for it. So, growth stocks are very much in line with, some of the ways you can think about long-term bonds and how they adjust to interest rate movements in terms of pricing. So unsurprisingly, as we've seen rates moving up over the course of the last few months, we've seen growth stocks be hit quite hard in terms of price. So we think that certainly can continue, and we'll certainly get into more of that here as we move through the presentation. So looking at fixed income rates, obviously bonds are a really hot topic right now. I've had probably more conversations with clients about fixed income than any topic, and that goes even through last year. So as we look at how rates have affected fixed income returns this year, I think it's a pretty grim picture, obviously. As you can see, everything across the board, at least for the asset classes that we've included in here, has produced a negative return. Now, one thing to point out about fixed income that's different from equities is that when we think about fixed income return profiles, a majority of that return is going to be generated from the income portion. And that income portion is usually paid out in monthly payments at the end of each month, at least on the ETF side. If you're looking, talking about an individual bond, it's usually semi-annually. But in this case, we're gonna use ETFs as an example. So right now, let's assume that we get paid at the end of the month. We've only got 1/12 of that return profile paid out to us this year. So there's still 11 interest payments that go throughout the year that can help cut in to some of these negative returns. So, one of the main questions I get, why would we hold bonds if we know that they're going to lose money? Well, one thing is we don't know for sure that anything's going to lose money. There's a higher probability that it could. But what we've done in our fixed income portfolio is try to balance out some of the risks that are inherent in fixed income right now and not have so much interest rate risk in the portfolio. So for us, we've tried to have a mix of income producing securities, which come through our mutual fund holdings that were added at the beginning of last year. We have our core holdings, which are going to insulate against equity volatility, and we'll see that in just a minute. And then you have assets that are going to try to insulate against any kind of interest rate risk that we have. And we've added positions like IVOL, and even some of the mutual funds have done a good job of absorbing that. So trust me, we are aware that the interest rate environment for fixed income is going to be challenging, and we're certainly not burying our head in the sand and ignoring that. We've already made changes to counteract that, and those were done as early as January of last year. So we certainly looked at that, but going forward, to take a look at the worst 5 days that we've had this year for the S&P 500. And then compare that to the Barclays Ag, which is basically the S&P 500 for bonds. And as we looked at the chart previously, was denoted by SCHZ, and just flip back there. So this line right here in blue, which from a price perspective is down around 4% so far this year. The performance difference on the days where the S&P really sells off hard, and I could have actually included today in there if I had had time. But you're getting some negative performance in there, but you're also getting days where there's positive performance. So the differential just from those worst 5 days in the equity market is around 10%. Now, what that means is that when it comes time to rebalance an account, when we see an equity washout or the conditions change, that differential will be used then to put back into equities or put back into risk when the time comes. In the meantime, it is being used as an offset for equity volatility. So, the goal in a bear market, and again, I'm not saying we're in a bear market, but in down markets is simply to not lose as much money as the S&P, because the math of loss is really, really harmful when you compound it over periods. So if we can lose less on the way down and then have that money to reinvest towards the bottom, that's always going to be something that's going to be beneficial from a rebalancing standpoint. So yes, I understand the frustration, obviously, from the fixed income side, where we've had some negative returns this year, but we've done what we can to diversify our fixed income portfolio without kind of totally going off the reservation in terms of also having a piece in there that can protect against some equity volatility going forward. Now, one area that we don't invest directly in, but certainly a part of the market that's come under some pressure is high yield bonds. And I know there's a lot going on in this chart, and it's very hard to read. So I don't, try not to focus so much on what these words say, more just follow the line, so to speak. So the red line is high yield spreads. So spreads are just the difference in interest rate between what the high yield bond is going to yield and then what a comparable treasury would yield. And when this,
Hey, Doug,
yeah, go ahead.
what's that other name for high yield bonds?
Junk bonds.
Yeah, junk. Yeah. So what makes these high yield is that they are questionable credits relative to higher quality bonds.
Yes, very much. So these bonds are more, as we would say, economically sensitive. So when you start to see these spreads move higher, and if you want to think of it as an inverse relationship, that means that the price of those bonds is going lower. And what you'll see is as these spreads widen out and get higher, you'll notice that you're also going to see equity sell-offs during that time. Now, what happened right here during the COVID crisis was the Federal Reserve stepped in and said, hey, we're going to be a backer of not only corporate bonds, but we may even buy high yield bonds if we need to. So right after that happened, you saw spreads for high yield go straight back down and then kind of just operate in this little channel right here for a while. But now over the past few months, you've seen spreads start to move higher, which in our opinion is showing that, this isn't only an inflation story now. We're starting to see some stress in the economy. We're starting to see some stress in some of the riskier areas of the market. And if this were to continue to move higher, we would certainly expect to see additional volatility going forward. Now we showed this chart in the last presentation, and I wanted to show it again because I think it's a really important relationship to think about. Because usually when we see things like this, we tell ourselves, okay, someone or something is wrong here. So this is the relationship between the 10-year bond yield and CPI. Goes back monthly since 1991. So this is a pretty large database. And what you'll see is all these boxes down here represent pretty much the past 10 months of yields. So this is the latest one in January. So you have CPI coming in at around 6%. And it's actually, if you took the latest reading, it would be closer to 7.5. But you still have the 10-year treasury yield, down around 2%. So when we look at this relationship, we tell ourselves, okay, something in here has to, I don't want to say break, but something has to change. So either inflation is, as the Fed says, or used to say, somewhat transitory and is going to come back down at some point, or yields are going to have to normalize a little bit and may continue to move a little bit higher than 2%. Now, it doesn't have to be a relationship where it goes up immediately, because I think if inflation were to stay the same and bond yields continue to move up, I think you're going to see incremental buying at certain yield points, simply because all the people who have been starved for yield for so many years are going to start to say, well, last year I could only get 1.5 on a 10-year treasury. Now I can get 2.5. Doesn't seem like such a bad deal. Now, some of you may say, well, it's still a terrible deal with inflation running so high, but you can start to see how people will start to step in at different yield levels to try to increase their income. But this is important because historical precedent would say that this relationship cannot continue the way that it's continued right now.
And so this kind of violates one of the rules of nature. Because if you think about it, with inflation at a rate that's higher than you can earn on relatively safe interest-paying investments, that is a very real economic loss, just as much as if the S&P 500 went down. And when you think about it a little further, because these are generally ordinary income assets, if they're held in a taxable account, the interest is fully taxable at your highest marginal rates. So you kind of have a double whammy in terms of the after-tax return. And so, as Doug said, something is broken in the logic here, and we're going to sort of pull together different things looking at interest rates. If the answer is that, yes, inflation is going to come down a bit, but interest rates have to come up a bit, then you can relate that conversation back to the value and growth discussion, because interest rates are used to discount growth stocks. So if interest rates are rising, then that's not good for that asset class.
Yeah, and as we talk about the Fed and interest rates, this is going back to close to 1950. We didn't have a Fed funds rate until about 1955. But here we see the relationship between the short-term rates, or the rates that the Fed really controls, versus inflation. And what we can see is that the Fed has pretty much done a good job of being on top of, or right around the level of inflation, to not let it get, quote unquote, out of control. I mean, even in the 70s, when we had kind of runaway inflation, they were still very much active in trying to reduce that by continuing to raise rates. And the Fed funds rate got as high as, close to 17 or 18% back then. But now you move all the way over here and you see inflation is all the way up here, and the Fed funds rate is still buried to the floor at zero. Not only that, the Fed is still doing $50 billion in quantitative easing. So to say that they're behind the curve here, I think is a massive understatement. And later on, when we talk about the difference between fast rate hike cycles and slow rate hike cycles, we think that this one is going to be on the very fast side, not necessarily in terms of having to go from 0 to 2 or wherever they end up, but the idea that they're going to have to raise maybe faster than they want to, but they're also going to have to address the $9 trillion balance sheet that they've accumulated over this time, and how the runoff or run down of that balance sheet is going to affect that as well. A complicating factor with this is looking at GDP forecasts. So we've had some very strong GDP numbers, and most of that has been off the idea of base effects. So we've talked about base effect before. Basically, the idea of a base effect is when you had GDP growth at whatever it was, 0, -15, -30 during COVID, and now you're bouncing back to have these extreme numbers going forward, you're going to have a lower hurdle to jump over to get a higher number. Now, as everything's kind of normalized a little bit, when we look at the GDP forecast, what we're seeing is that the consensus is starting to go down, and it's been going down for a few weeks now, moving all the way down here to roughly 2%. The Atlanta Fed GDP now, which is a real-time estimate, actually has the number below 1%. So there's a very real concern out here that the Fed is going to be trapped by the inflation picture, and they're going to end up raising rates into a slowing environment, which is kind of the worst of all scenarios, because any rate hike into a slower growing environment could accelerate that slower growth, with the ultimate kind of worst case scenario being a severe recession, or what we call a stagflationary environment where you just get low growth and high inflation. So originally this wasn't as much of a concern, but now it's starting to become a little bit more of a concern. And when we talk about longer end rates and concern about those continuing to go higher, we have to remember that the Fed does not control that end of the curve. They can try through QE, but they just announced their ending QE. So if we start to see growth slow down, you may see a cap on long-term rates, or even the rates come down a little bit, which would put a bid into some of those bonds that we talked about earlier, while still having short-term rates go up, simply because the Fed is going to have to fight inflation through rate hikes. Now, one thing that we have also seen is an uptick in performance in defensive or value versus growth. And we've seen some extreme measures, ones we've only seen a few times going back to the Great Depression. So this shows these blue bars represent the performance differential basically between value and growth. And when the bar is above this line, it means that the value, the rolling 1 month return for value is greater than 7% over growth. And there's been 3 other times when that's happened before right now, because it's currently taking place. And 2 of those have been met with a pretty significant market drawdown. Obviously, one during the Great Depression. We have one here in the mid 80s that turned out to be much about nothing. But then we also have here, which was the tech bubble. So again, we're not saying that this is going to quote unquote guarantee that we're going to enter a bear market. But it's certainly showing that the positioning and the performance of certain asset classes is certainly setting up for a much tougher environment going forward, and one that involves higher rates and higher inflation. And for us, we have to take the Fed at their word in believing that they're going to actively fight this. Now, you look at the two previous times that we've had any kind of adjustment in terms of the Fed funds rate, and this is the futures market. So this is just this is the market's expectation of where rates are going to go. We have the taper tantrum back starting in 2013. And the interesting thing about this is that the Fed never raised rates. This was simply the market pricing it in. And that was enough to have the equity market get thrown into a tizzy and have some significant volatility. And then we've already talked about the late 2018 sell-off. You actually had the Fed funds rate move higher, but it got to a point of breaking the market, so to speak. You had a quick 20% sell-off, and we'll look at this in a little bit more detail here in a minute. But now you're starting to enter this period again where you have the Fed funds rate starting to creep up, pricing and rate hikes, and it's really what is going to be too much in terms of really affecting the equity side, and is the Fed going to be able to do anything about it? Because we didn't have 7% inflation here, and we didn't have 7% inflation here.
Hey, Doug,
a little bit. Yeah, go ahead.
Just before you click away, we have had a couple of questions come in regarding expectations for interest rates over the balance of the year and how many bumps we think the Fed may do, and And although I didn't see it in a question, one of the things that's actively discussed is when they do make these increases, are they likely to be 50 bips or 25 basis points? While we're on this Fed Funds futures slide, this may be a good time to talk about what the market expectations are, just to take another minute or two with that.
Sure. So I don't want to get too into the weeds here because there's two components to this. The first being that, in October of last year, there was a 0% chance the market was pricing in a 50 basis point hike in March. There's currently about a 60% chance that the market is pricing in a 50 basis point hike in March now. So things can change quickly. We saw the Fed minutes yesterday. They didn't change a whole lot, but that was also before we had pretty hot inflation numbers. So the consensus forecast right now from a market standpoint is anywhere from 4 to 7 hikes. I think 7 hikes is a little on the extreme side. Just personally, I don't know that they'll be able to get there. But I think if they're truly committed to this, you could see 4 to 6 with no issue, or they could try to use the balance sheet reduction as a kind of pseudo tightening, as opposed to the interest rate hike, so to speak. But the interesting thing about this is if you go out a year or two, the market is actually pricing in rate cuts because they're worried about this over tightening actually slowing the economy to a point where the Fed's just going to have to turn around and cut rates again. So it's a very interesting dynamic that you're seeing right now. And I think it speaks to a bigger problem here, that the Fed has become so involved in the market pricing mechanism that they're almost too big, and price discovery and normal functioning of markets almost has become so distorted that they're kind of the only game in town right now. And it's a frustrating proposition, I think, for a lot of people to try to have to, listen to the words of these folks to determine what markets may or may not do. But unfortunately, that's the situation that we're in.
But also add that they will regularly tell you they're data dependent. So while everybody's trying to predict what they will do, they're just as curious as the rest of us to see what the inflation numbers are going to be in the summertime, decide what they're going to do in the fall.
Yeah.
I don't think they know. If the economy does start to roll over, then they're going to behave very differently than they would if it doesn't. Yeah.
So I have seen a lot of questions come in, and we'll do our best to get those answered here at the end. But I want to make sure we get through these slides here because we do have a few left. So we talked about tightening cycles and how to position for those. And I think there needs to be a distinction between a slow cycle and a fast cycle. And it bears out in the performance of the market, where slow interest rate hike cycles, talking about one rate hike, meeting in between, another rate hike, maybe 2 meetings in between, and on. Those usually don't have a lot of negative effect for the market, so to speak. And you can see, the slow line that's denoted in here is this blue line, and this denotes the first rate hike in the cycle. You get 12 months after that, and this is the equity returns for the S&P 500. So, all in all, everything looks pretty good here, unless you're in a fast interest rate cycle. And the last few that we've seen, 94, 99, and 2004, I want to look at in a little bit more detail here to see how it may compare to the current cycle we're in. Just to give you an idea, that the average return in a fast tightening cycle gained during the first year is actually negative 0.27%. And then it actually bumps up to 4.3 in the second year. But if you compound that, that's a pretty low equity return, basically almost a flat line. So let's take a look at 94 first. And all of these are going to have charts that are going to show the level of the S&P 500 in purple, the effective Fed funds rate in orange, the 10-year treasury rate in blue, and then the CPI in green. So I listed these out here as well, so you can see them visually. So in this rate hike cycle, really much to do about nothing, quite frankly. You had the S&P 500 returning about 60% over that 3-year time frame. You had the beginning S&P PE ratio at about 21, which still elevated in terms of looking at the overall averages, but not egregiously high. One thing to point out here, the ag, which is the bond index that we mentioned earlier, did have a positive return over this time period at 5.8%. You had GDP growth at a healthy 5.6, CPI growth at 2.75, and then you had a 10-year treasury at 6 to 8%. So one thing to point out here is you had a positive real yield of about 5%. So if we looked at this and, somebody was trying to, kind of prepare for what might come, and they looked at this and they might say, oh, I don't think it's really going to be that big a deal. Now we go to the next time frame, and we have 99 to 2002. Very, very different time frame, very different results. And I hate to say it, probably some similarities to the time frame that we're in right now. So the S&P 500 for that return period was negative 28.9%. And for growth stocks, it was much worse than that. As you can remember, this is the tech bubble bursting. S&P 500 P ratio at 32.3. So probably the highest point that we've had in history, thanks to some egregiously valuation tech stocks included. Bond return 26.4% over this 3-year period. Now, why is this important? Well, first of all, you had the Fed raising rates, the market not liking it, the economy moving into a recession as we move through this period, and then the Fed cutting rates back down. So as rates move down, recession, you can have good bond returns, and we can see that right here. GDP growth actually averaged 5.3%. Most of that was front loaded. And then you have CPI growth only around 2%, 10-year treasury at 4.5 to 6. So again, you have a real positive yield here as we look at this time frame.
And just as a reminder, we're sitting on top of a fairly significant negative real yield right now.
Yeah, we'll see that in just a second. So then the last time frame, 2004 to 2007, again, very good equity return, 31.8, a lower PE ratio than we had. Bond aggregate return still positive as we went from 1.5 all the way up to 5 on the Fed funds rate. CPI growth a little bit higher than 3 with 3.5, and then the 10-year treasury from 4 to 5. So you had a 1% positive real yield. Now, what I will say is, if we showed the other 3 years after 2007, the return picture was not pretty. This kind of led us into the great financial crisis with maybe what some would call an over tightening of policy into a slowing economy, which had something to do with the match that lighted that whole fire. But certainly when you look at these numbers, I think it'd be disingenuous to not pay attention to what's on the other side of that. But in terms of consistency, we were doing 3-year time frames, so we wanted to maintain consistency there. So now as we move into 2022, how is this going to look compared to some of the other time frames we've seen? So we don't know what the S&P 500 return is going to be over this 3-year time frame. We haven't even gotten to the first rate hike yet. We're already seeing some downside volatility here. You have the S&P 500 P ratio at 25, which isn't the 32 that we saw in 99, but it's higher than both of the previous periods that we saw in 2004 and 1994. GDP growth has been good, but now, as we saw through these forecasts, certainly lower than what we've had previously. And then I think the most concerning thing is CPI growth at 7.5 with a 10-year treasury of 2. We have a pretty big negative real yield here. So as we showed in the chart earlier, something's going to have to give on this relationship. Either it's going to have to be inflation being transitory, or yields are going to have to go up. But again, could there be a cap on where real or longer term rates are going, because there's concern that this rate hike cycle is just going to slow the economy down enough to put us into a recession? Now, we talked a lot about the end of 2018, the beginning of 2019, and this is that time period in orange, analogued over the S&P 500 return of today. So in this blue line, and history doesn't necessarily repeat itself, but it can certainly rhyme. And this chart is eerily on top of each other, where we've kind of gone through our tightening tantrum with the initial, 10% sell-off that we've seen. We're kind of in the middle of this jagged recovery back and forth. And if this follows the same analog, we're not saying it's going to, but if it does, we would expect to see a further growth correction here as those long duration assets kind of wake up to the fact that, yeah, rates are really going up. They're not bluffing, and this is actually going to happen. Now, subsequently saw a bounce back there. But the point is that there could be some more pain in terms of some of those high flying, low quality growth assets that everybody fell in love with during COVID. And as we talk about portfolio positioning, as we go into these tightening cycles, what we found is that high dividend yielders have outperformed low dividend yielders in those cycles. Maybe not through the first 8 months, initially very much so, but over the next 2 years, certainly that relationship has held pretty steady. And then same with fast for slow growing dividends, mixed in year one, but very strong in year two. And I think this goes back to the point that if you're going into a tightening cycle, you're going to want to own things like dividend growers. You're going to want to own things like value. You want to own things like, maybe not super high yielding stuff, but high dividend securities that can provide some cash flow there, and maybe not so much the low quality growth that we've tried to rotate out of a little bit. Now, how does that growth value relationship look like in terms of when we've had these periods that we just highlighted? Well, 94, it was pretty much a wash. Whether you own growth or value, it didn't matter. You did well. But now look at the tech bubble and then look at the 2004 tightening cycle. Remember, when this line is going up, it means growth is outperforming value and vice versa. So yes, you had a big growth boom here, but then value came out and really killed it on the other side of this. If you take this line straight down, clear win for value. And then again, another clear win for value in a tightening cycle. So we are very much of the position that as we go into this tightening cycle, it's going to be one where you're going to want to own more value than growth. You're going to want to own things like dividend, and you're going to want to own things that are a little bit more defensive maybe than you have in the past. So to kind of summarize all this, we believe that current levels of inflation have really put the Fed in the bind. They're way behind the curve based on historical precedent. So both the bond and the stock markets have begun to grapple with the expectation of a more aggressive Fed, and they're trying to sort of work out what that's going to look like. So now, in addition to inflation concerns, you also have growth forecasts being lower, and the Fed forced to raise rates into a slowing economy is not really the outcome that you want. Now, we didn't even talk about geopolitical tensions between Russia and Ukraine. I think while those remain a concern, they ultimately are not going to change the trajectory for the Fed outside of a full-scale war. And personally, I don't think we're going to get to that. I think you might see a little bit more saber rattling here, but we don't anticipate a World War III event. And even if we did, I'm not sure how you would position a portfolio for something like that, other than putting your cash under a mattress or something along those lines. So ultimately,
to the extent that would get more significant, for example, if it rattled the energy markets or something along those lines, then the positioning you're describing would still be favorable.
Yeah. So ultimately, we believe that this uncertainty with the Fed, combining the deteriorating market internals that we've seen, it's materially increased the chances for further downside volatility. Now, when I say that, I'm not saying we're going into a bear market. So please, hear us when we're not making that call right now. We're not saying you should go 100% cash. What we are saying is we think there's enough concern out there based on the things that we've seen to maybe start to lighten portfolio risk a little bit. And that's exactly what we've done in our tactical model. So we were at, always using a 60-40 as kind of an example. We were at 62, which was slightly overweight equities. We've reduced that down to 55. So a 5% stock underweight in tactical models. So we raised about 6 to 8% in cash very recently. We've increased our allocation of value in dividends. We've removed small cap from the portfolio completely. And we've reduced our growth holdings to kind of fund that value trade. We're still underweight foreign relative to our benchmarks, but I think most people would would look at that and say we still own a pretty healthy amount of foreign, which we're fine with right now because foreign has been outperforming the U.S. through the beginning of this year. So will it hold is yet to be seen, but that's been kind of a long time coming, so to speak. And then, we talked about the diversification across fixed income, trying to hold a combination of things like global macro, inflation strategies, and core strategies as well. And then, further deterioration in these market internals could certainly lead to additional risk cuts. But I would also caveat that with, and we don't really talk about this a lot, but any pivot by the Fed or deterioration in inflation could actually bring about a buying opportunity, because I think the market is very much focused on the new expectation of a very tight Fed, and any reversal of that in short order could put us back in the same situation that we've been in, where easy Fed, low rates equals positives for risk assets, so to speak. So that is kind of in a nutshell what we've done from a portfolio standpoint to start making adjustments now. We have had a few questions come in here, so I want to make sure that we get to those here, and I'm going to try to see if I can bunch a few of these together. One kind of talked a little bit about the reduction in bonds and move to stocks. Do we consider that to be market timing? I guess you could say it's market timing. I think market timing for different people has different definitions. I think for some that means making really big portfolio adjustments, either going all cash or all stock or something like that. But for us, if you want to use the term timing, I guess that's okay. I'm comfortable with it. I think more of it is a tactical rebalancing opportunity when we're taking a look at these internal market indicators. They're giving us either red flags that it's time to reduce equities, but sometimes it could also get to the point where it says, the risk return profile has changed so much that you'd be better off buying risk than continuing to cut it. So, I know market timing for some is kind of a 4-letter word, and I would agree to it if you take it to an extreme. But in this instance, I think we're doing it in a responsible way and not taking huge bets in here to where if we get it wrong, that it's going to be very detrimental to portfolios.
I think
then, go ahead.
I would just add to that. I don't think of it in the sense, I think of market timers as are traders who look at their indicators and think they know what's going to happen tomorrow. That's certainly not the perspective that we take. And I think you said multiple times, even today, we're not predicting this or that. But what we are doing is recognizing the reality that by and large, we help manage money for people who are either in retirement or planning for retirement. And there's a thing called sequence risk, which is a risk of excessive volatility, can have disproportionate bad outcomes for people who are in distribution mode or drawdown mode in their portfolios. So I would say what we're doing is we're looking at all the data we have access to and making risk management decisions. And really that's what motivates. The idea is not necessarily to outperform a strategic investor. And we run strategic solutions that don't make these tactical adjustments, but instead are very active in a rebalancing mode. But again, for people who are in or near retirement, sequence risk is a very real thing, and it makes sense to actively manage that risk.
So another one says, can you touch on the 2 to 10-year rate? I don't know if this is talking about the yield curve, but is it saying recession? So this is where I talked about this divergence in terms of timeframes, and the rate picture from a market perspective can get very complicated. So I'm going to try to explain this as best I can, but if it comes off as confusing, I apologize. And we can certainly follow up with your advisor, and we can try to get you a better understanding. But so right now, the yield curve is flat between the 2 and the 10-year. And it's been a combination of the shorter end of the curve going up faster than the longer end of the curve. Now, normally when you see the curve flattening, there is concerns about growth going forward, especially when you see short end rates moving up faster than long end rates. If you look at where the curve is now, I think it's like 60 to 65, 70 basis points. So we're still not at inversion levels. But as I mentioned before, if you were to go out a year or two, those curves are priced at inversion levels. So they are predicting that based on those numbers that you may see a recession in 2 years. And that's, again, 100% based on the idea that the Fed is going to over tighten because they have no flexibility in this situation at all. And it's going to cause problems. Now, there's also a lot of investors, I think, who are sitting on this, sitting there saying, we're calling the Fed's bluff. We don't think that they're going to do anything to ultimately harm the market. And we're going to adjust, we're going to invest accordingly here. So I think there's a little bit of game of chicken as well, but, for us, we have to take the Fed at their word and, see that if they say they're going to raise rates and tighten the balance sheet, we're going to expect them to do that until they don't. And then, in terms of markets kind of pricing in the rate hikes and how many rate hikes have been priced in, I think it's hard to say what the market's priced in and what it hasn't priced in. I mean, it's easy for the market to say it's priced in 6 rate hikes, but if 6 rate hikes happen this year, I expect a lot of volatility to happen. And if you think the market is priced in anything well, then theoretically nothing should change. Like the market should literally just go sideways because it's already, assuming everything that happens. So I know we use that term a lot, but I hate it because I think it sometimes doesn't make any sense to me. But I think the market is assuming at minimum that we're going to see 4 rate hikes. The wild card is they don't have any clear indication of how the balance sheet is going to get run down. And we've showed a chart before about how the S&P has really followed the Fed's balance sheet almost dollar for dollar, especially since the bottom in 2020. So I think while rate hikes are important, I think also the language around the balance sheet is going to be very important as well. So if you've got those two things, if inflation stays high, and you get a really, really aggressive Fed, talking about levels, specifically is the bottom that we just saw in the S&P going to be the bottom for the year? It's hard to make that assumption, but I think that it would not shock me if we went down and tested that again, and maybe even went through it while we're trying to sort out exactly what the Fed is going to do here in light of everything else that we've talked about. So how do we feel about gold as it approaches 2000? There's some questions about some technical analysis in there that I'll be honest, I'm not the technical guru in this office. So I will have to talk to our technical guru and get back to you on that. One thing I will say about gold is gold has been historically inversely related to real yields. So the more negative real yields get, the better gold prices have got, and vice versa. So the last time I looked, I believe that real yields are actually increasing. So you may just be getting a bid on gold right now due to the fact that you've got geopolitical issues in Russia. But we've talked about gold a little bit, and I'm not sure that gold is the best inflation hedge. But as it approaches the level that you mentioned, it's hard for me to say whether from a charting perspective, there's an opportunity there or not. So I can certainly have somebody follow up with you on that. And then I think we have time for one more question here as we're closing on an hour here. Thoughts on crypto? I will say the same thing that I've said about crypto since I've been asked about it. I think if you are interested in crypto, you need to be honest with yourself. And most people are getting involved in crypto as a speculation, and they look at the returns that some people have gotten over the past 10 years and think, well, why wouldn't I want to be able to get these returns? Well, my opinion, those type of returns are gone. They're way gone. And, you have Bitcoin at, I think, $40,000 right now. And some people are throwing price targets out $80,000, $100,000, which is a lot of money for a single coin. But from a percentage standpoint, it's only a 100% return. So these 10,000%, 100,000% returns that we've seen in crypto early, I don't believe those exist anymore. So it's no different than buying a stock that goes from $5 to $10. And the other thing we're going to find out in short order is that the theory behind crypto is that it's this kind of alternative source of money for when inflation runs out of control and the dollar collapses, that it's going to somehow be this unbelievable store of value. Well, inflation's running at 7.5%, and crypto isn't going straight up. So if that theory doesn't hold, I think that we need to be honest with ourselves, and it is probably just another risk asset that's getting pulled into the mixture of low rates and high liquidity. So I know we have some more questions that we didn't get to. We'll do our best to follow up with those folks and get them answers to the questions they had. But I think we're right at an hour here. So Mike, I think it's time that we wrap up.
Yeah, we are approaching our hard close. So thanks, everybody. That does it for today. As always, if news breaks, we will be back with a sort of in-between editions of this. If news doesn't break, then we are scheduled for our next webinar on Thursday, March 24th. In the meantime, again, if you have any questions, feel free to contact either Doug, me, or your advisor. And that should really do it. If you know anybody that could use a hand, we are more than willing to help somebody if we can. That does it. Thanks, everybody. Bye-bye.